Don't put all your eggs in one basket. It is a phrase we've all heard of. Diversification is often cited as one of the key strategies to successful investing, and for a good reason. By spreading your money across many investments instead of putting it all in one stock, you can mitigate the risk that you will lose it all or a significant part of your money in a single investment. But is diversification really the best strategy? Would knowing a lot about single company be better than knowing little to none about many? Let's find out. When investing, there is always a risk. No matter if you diversify or not, there is also a risk when not investing at all. So risk is everywhere all the time. So let's discount risk from this equation at all. In case you're new to this, 5% return, even 10% when you are poor is awful. This is what diversification offers. It's not motivating enough for you to put the work. Let's be real. Amazon soared more than 117,000%, which gives us a 32% average annual return over the last 25 years. A $10,000 investment would be worth over $16 million. If you have invested $10,000 with the founder Elon Musk 10 years ago, your stake would be worth $2.1 million now. That's 70% average annual return. Legendary investor Peter Lynch, who is one of the great teachers for retail investors, achieved 29% annualized return over 13 years, said,
"Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%. So you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories, and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage. So
if you are new to investing, if you are young or starting out, diversification is not good for you. Never invest in just one stock if you're not willing to lose 80% or more in unrealized losses in 1 or 2 years. Or you're prone to be emotional. Unrealized losses is not a loss until you sell it or a company goes bankrupt. If you know your company is making money, growing rapidly, has enough cash and low debt, and nothing has fundamentally changed, then 80% fall is a Black Friday for you. This strategy is extremely volatile. There is no denying that investing money in one stock brings a lot of volatility. I love volatility. Volatility is great because it teaches you mental and emotional discipline. I know that I own great companies with perfect balance sheets. So 80% fall is an opportunity to buy more. If you would use your time and energy to find just one stock that you really like, spend an hour a day to study your company, really understand what you own and why you own it, then you have a complete control of what you have invested in. Once you know the drill and you are confident enough in your investment decisions, you then find a second one, and so on. Eventually, you can become a full-time investor. A retail investor should not have more than 5 companies in their portfolio if they work a full-time job. If you think otherwise, let me ask you this. Can you name all the CEOs of the companies you've invested in? If the answer is no, then you don't know where your money is going. Would you give your money to a stranger? No, but you did anyway. Once investing is your full-time job, then you can have up to 15 companies in your portfolio. A reminder, 15 companies equals to 60 financial statements per year. With the average of 200 pages, that equals over 12,000 pages. That's a lot. To finish it up, Warren Buffett said,
"We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market. You own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. But 3 wonderful businesses is more than you need in this life to do very well.
If you've spent years studying the industry and you know it inside and out, then you should deploy your knowledge and invest in a single company. That's not a gambling, that's investing with deep conviction. Unless you are a portfolio manager managing hundreds of millions or billions of dollars from your clients, where you can't afford volatility and where 5% return still brings shit amount of money, or you're a retiree who want to live off his investments, then diversification is good for you. If you're still watching, then thank you. Let me know in the comments if you could invest in one stock, which stock it would be. And don't forget to like and subscribe. See you in the next video.